A bank run is quietly unfolding in 2026, and most depositors have no idea. Statements appear normal. Balances seem secure, but unallocated accounts are now a major risk. Banks are under regulatory pressure to comply with Basel III and NSFR rules. Paper claims are no longer sufficient to meet capital requirements. Every unallocated account is a liability on the bank's balance sheet, and banks are acting to protect themselves. Depositors who think their funds are safe may be exposed. Banks are converting unallocated holdings into cash or physical assets to reduce risk. This process happens quietly, behind closed doors. The average client does not see the emails, the internal memos, or the liquidation instructions. Access risk is real, and timing is critical. Depositors may find themselves unable to withdraw their unallocated funds without delays or reductions. Banks prioritize regulatory compliance over individual convenience. Every transaction, every conversion, every liquidation is designed to meet regulatory thresholds. The system has changed. Unallocated accounts are no longer safe. Statements give the illusion of security, but the underlying mechanics are driven by compliance, not customer service. The implications are massive. Large institutions are reviewing client accounts and issuing letters instructing conversion to physical assets or cash. Those who delay face the risk of receiving their assets at unfavorable valuations. The market is forward-looking. Banks act ahead of deadlines and industrial buyers follow. Retail depositors are last. Every unallocated account converted or cashed out reduces the systemic risk for the banks, but increases pressure on the remaining holders. Those relying on paper promises are exposed. The hierarchy is clear. Banks first, industrials second, retail last. Timing defines advantage. Physical possession is security. Paper or digital claims are increasingly vulnerable. The market responds to these forced actions. Exchanges see higher volumes as banks adjust their holdings. Futures, FX, and derivative markets react to liquidity shifts. Prices for physical metals rise as banks hoard assets. Retail investors notice price movement but may misinterpret it as normal volatility. The reality is regulatory-driven accumulation. Every unallocated account converted is another step in a systemic adjustment. Access risk grows as physical assets are prioritized over paper claims. Depositors holding unallocated balances are at the mercy of banks' compliance decisions. Short-term liquidity may appear sufficient, but actual control over assets diminishes. The alert is active. Every bank is reviewing exposure. Compliance dictates action. Letters are sent quietly, internal systems adjust positions, and the public. Every transaction reduces available physical inventory. Industrial users scramble to secure remaining supplies, facing higher costs and delayed delivery. Statements and dashboards mislead. Only possession guarantees security. Paper reliance risks exposure. The sequence is deliberate and regulatory-driven. Timing defines advantage. Depositors who act early can convert their holdings safely. Those who wait may face limited access and increased costs. Physical metal and cash are the safe harbor. Banks hoard to meet Tier 1 asset requirements. Industrial users compete for the same physical resources. Retail participants face scarcity. Pricing adjusts. Access tightens. Awareness and preparation define advantage. The bank run is not speculation. It is a compliance-driven shift in asset control. Allocated accounts become liabilities. Banks act to protect balance sheets. Deposit access is constrained. Statements mislead. Paper or digital claims cannot guarantee security. Industrial buyers compete with banks for physical metals. Delivery schedules extend. Costs rise. Short-term volatility masks long-term scarcity. The hierarchy is enforced. Timing is everything. Every conversion accelerates scarcity. Depositors who understand can act. Those who ignore may be priced out or delayed. Physical possession defines security. Paper reliance risks exposure. The alert is live. The bank run of 2026 is unfolding now. Compliance drives behavior. Banks hoard, industrials panic, retail observes last. The market mechanics are deliberate, regulatory-driven, and immediate. Timing, awareness, and possession determine advantage. Every unallocated account converted reduces systemic risk for banks, but exposes remaining holders. The hierarchy is clear. Physical possession is security. Paper claims are vulnerable. The alert is critical. The bank run is real. Depositors risk losing access if they do not act. Compliance drives action. Banks act first, industrials follow, retail last. Timing and preparation define advantage. Physical metal and cash ensure stability. Paper reliance risks losses. Awareness is essential. The hierarchy is enforced. The bank run is active. Alerts are live. The system is responding. Depositors must understand and act to protect their holdings.